The U.S. housing market just sent a warning we haven't seen since 2008. Buyers are disappearing. Not slowing down, not hesitating, disappearing. And now, the government is stepping in to replace them. Over the past few weeks, something broke in the mortgage market. Mortgage-backed securities, the bonds that fund your home, started selling off hard. But this wasn't just a normal rate move. The gap between Treasury yields and mortgage rates suddenly widened. And that tells you something critical. The system isn't transmitting anymore. Investors aren't just afraid of high rates, they're afraid of instability. And when bond prices fall, everyone holding them takes a hit. Banks, asset managers, pension funds. Because these bonds sit across the entire financial system. This is not isolated. This is pressure building everywhere at once. But here's where it gets dangerous. As rates stay higher for longer, these mortgage bonds start to behave differently. People stop refinancing. Loans stay outstanding longer than expected. So the risk doesn't shrink, it stretches, right when prices are already falling. That forces investors to sell even more, just to control their exposure. And that's how a sell-off turns into a trap. Liquidity disappears. Buyers step back, prices fall further. So what happens when the private market walks away? The government takes over. Fannie Mae and Freddie Mac are now placing massive bids for mortgage bonds, backed by a $200 billion directive. This isn't support. This is replacement. The private market is stepping away from housing risk, and the government is absorbing it. But this didn't happen in isolation. The escalation with Iran is pushing oil prices higher. That feeds inflation back into the system. And when inflation stays sticky, long-term interest rates move higher. The 10-year, the 30-year, and when the long end moves, everything that depends on cheap financing starts to break. Corporate borrowing, refinancing, and the weakest part of the system, private credit. These are loans built on stability. But stability is gone. Defaults are rising. Investors are pulling money out. Funds are starting to limit withdrawals. And when credit tightens, it doesn't stay contained. It spreads from private credit to public markets, and now into housing. Because housing is just another form of credit. And when private buyers step back, the system has only one option left: intervention. But here's the problem. Mortgage rates don't follow policy anymore. They follow the long end of the market, and that's still rising. So even with government buying, rates stay high, housing stays frozen, and that leads to only one path forward: more buying, more intervention, more dependence, until the market stops functioning as a market at all. Because when private capital leaves and the state takes its place, price discovery disappears. And once that's gone, the market is gone too. This is the signal. The plumbing is being nationalized, quietly. And once that process starts, it almost never reverses. This is Macro Pulse. Global Notes by JP. If you want to understand the structural shifts before they hit the headlines, comment, like, share, and hit the bell.